In this quick video series, I'm going to show you how we trade 30,000 SPX 0 DTE trades a year and how you can too. Maria and I weren't always fund managers. Maria was a banker and was the #1 house flipper in the United States. I started and sold 2 internet companies and retired at age 42. Before that, I was an attorney, and for the last 50 years, I've been a professional gambler. Today, Maria and I manage several funds. We trade over 30,000 SPX 0 DTE trades every single year. We backtest 20 million trades every single week. We use AI extensively to help select those trades, and every single one of our trades is put on by robots. We never use our fingers to trade. We're going to show you exactly how we do it. Our entire trading system is based on math. Our philosophy is math makes money. We do lots and lots of very small trades. We bet with our head, not with our hearts. I often say bet rather than trades because of my prior history as a professional gambler. Now, you can see here that we've done in the last 90 days, we used $1 million worth of buying power. We made about $218,000, capturing 12.5% of the premium. We sold about $1.7 million worth of premium in those 90 days, and we did 7,813 trades. That's pretty typical for a quarter. On our YouTube channel, Rob and Maria Trading, the viewers said to us that they don't have $1 million worth of buying power in many of their accounts. So they asked us to create something smaller. So we created the $30,000 challenge about 70 days ago. What we do is we give on Sunday night 6 trades that we're going to do every single day of the following week. Then we put those 6 trades on and we track the results. By the way, on Sunday night at 6 p.m., we also give out 14 trades that we're going to be doing in our $1 million funds, $1 million worth of buying power funds for the following week as well. So you can follow along with exactly what we're doing. Everything in our system is based on math. Again, math makes money. We are looking for a mathematical edge, and that's what I'm going to show you how we do it. We bet with our heads, not with our hearts. So as you can see very, very clearly here from these results, that we made about 27% or $8,000 in 70 days. That equates out to a little over 100% per year. Now, those results are better than we normally get, but they are what they are. I just want to show you that our system does work. Here's what I'm going to teach you today. I'm going to teach you how to pick the best trades with AI. I'm going to teach you how to make those trades with robots. I'm also going to teach you how to talk the SPX lingo. Below you can see 2 different types of trades that I've described. The 1002 $2 MEC 150W 95% SL. By the end of this video series, you're going to be able to understand exactly what that is, and you'll know exactly how to make that trade. 5 parts. We're going to do this in 5 parts. Each part is going to be 5 minutes. We're going to keep it really short. We're going to show you everything that we do and how we do it. Let's get started with part 1. For purposes of this presentation, I'm just going to discuss 2 trades that we primarily do in our funds. We primarily do the multiple entry iron condor or the MEC. We also do the exponential moving average or the EMA. We do lots of other strategies in our bigger funds like double calendars, opening range breakouts, reverse iron condors, covered calls and wheel strategies, naked puts and strangles. But that's not going to be something we cover today. We're just going to focus in on the MECs and the EMAs. What is a multiple entry iron condor? It consists of 2 credit spreads. You're going to have a put credit spread and you're going to have a call credit spread. They're going to be entered at the same time, but not together. So by that, I mean you'll enter a put credit spread and a call credit spread at the same time, but don't enter them as a 4-legged trade. Enter them as 2 2-legged trades. Each one will be for the same price. So we're going to show you, for example, if you're entering for a $2 premium, you're going to get $2 for the put credit spread and $2 for the call credit spread. And we'll get into the details of that in just a second. A little bit more on nomenclature. What is a put credit spread and what is a call credit spread? Both of them obviously are spreads. The put credit spread consists of a short put and a long put. The call credit spread consists of a short call and a long call. If we're going to put on a $2 MEC, that means on the short leg of the put, we're going to try and get $2 credit. On the short leg of the call, we're going to try and get $2 credit. If we then buy a long leg for, say, a nickel on the put, when we buy a long leg on the call for a nickel, each one of those is going to have a net of $1.95. Now, the way it works in options is because you are trading 100 shares of the underlying stock or the rights to purchase or sell the underlying stock, you're going to get $195 for that put credit spread at $2 minus the nickel for the long, and you're going to get $195 for the call credit spread, $2 minus the nickel, provided that they expire worthless at the end of the day. And that's the game. What is an exponential moving average trade? It's a little more complicated, but it's not that difficult. You are going to be looking to do either a put credit spread or a call credit spread. Remember, on the MEX, you did both. On the exponential moving average, you're only going to do one. You're going to do one or the other. And how you decide is you compare the 40-minute moving average, exponential moving average, against the 20-minute exponential moving average. And the idea is if the market is going down, you're going to sell a call. If the market is going up, you're going to sell a put. The theory being that if the market is heading in one direction, it will either continue in that direction, or if it reverts, it won't revert enough to come down and to punch you out. All right, so now let's talk about the lingo. This is the 1002 $2 MEC 150W 95% SL. What does that mean? 1002 is the time we're putting these trades on. This is Eastern Standard Time. I live in Daytona Beach, so Daytona Beach time. $2, that means the amount of money that you're trying to get on the short leg. Remember, we talked about selling the short and buying the long. This is just selling the short on the put credit spread, and then another $2 selling the short on the call credit spread. MEC means obviously MEC or EMA. 150W, that means the width between the short leg and the long leg. You can have the width be $10 or $50 or $100 or 150. If it says 150W, that means you want it to be 150 wide. Now, there is some buying power implications and some other implications about that. We'll talk about that later. Then 95% is the stop loss. And everybody gets the stop loss calculation wrong. We're going to go into detail that in just a few minutes so you understand exactly what 95% stop loss means. Let's focus in on the 150W. That refers to the long leg selection. Long leg selection is used for buying power reduction. It's not used to limit your loss. The stop loss limits the loss. The long leg is not used for that. All we're doing is reducing the buying power that we're going to have to utilize. Buying power is $1,000 for every $10 in strike movement. So for example, if you had a 20 wide, it'd be $2,000 buying power for the trade. If it was 50 wide, 5,000. If it was 150 wide, 15,000. Pick the biggest buying power that you can afford. Also, when I tell you 150W, it doesn't necessarily mean it'd be 150 wide. It means start at your short leg and start moving away from it. And you stop at the first one that you can buy for a nickel. If you can buy one for a nickel and it's only 100 wide, just go ahead and take that. If you can buy one for a nickel late in the day and it's only 50 wide, do that. But if normally in the beginning of the day, you're going to get that first nickel, you have to go 150 wide. Now, if the limit is 50 wide because you don't have much buying power, again, the same rules apply. You start at that short leg, you move $10 away, $20 away, $30 away, and you look for the first one that's priced at a nickel. When you find one that's priced at a nickel, you take it. If you get to 50 wide and you still haven't found one with a nickel, you just buy that long at 50 wide. That's the 150W part. Here's an example of selling the target premium. You want to buy that first nickel or 100 wide in this particular instance. So you notice here that we sold the short at 68.35. We started moving away from it and we're looking for the first one that's a nickel, and 67.95 is a nickel. Now, that's only 40 wide. Even though our contract on this one was supposed to be 100 wide, we only had to go out 40 wide to get the first nickel. So you want to do that because now that really is going to limit the amount of your buying power. Remember how we calculated buying power in the previous slide. So you want to go to the first nickel or your maximum width, whichever comes first. Let's talk about that pesky stop loss percentage. In our example here, it's 95% stop loss. Stop loss shows you how much you can lose in theory, not in actuality, but in theory. In theory, what you're doing is you're telling the broker, if my short leg, if the market goes against me and my short leg is going to cost me a lot of money to get out, I want you to stop my loss at 95%. Now, what does that mean? A couple of things you need to talk about before we do we're going to do a calculation in the next slide. But what happens is when you tell your broker you want to stop loss, if you're using a robot, you can do the stop loss either at the robot website, right, which it checks every minute or so, or sometimes every second, to see if there's a stop, if you've hit your stop, and if you have, it'll send an order to the broker. The broker will send it to the CBOE, the Chicago Board of Exchange, and the Chicago Board of Exchange will send it to a market maker, and the market maker will execute the trade. That's a lot of steps. Also, if your robot company is only checking once every second, that's a lifetime when we're trading SPX 0 DTEs. What happens is the CBOE breaks every second into 10,000 milliseconds. So it's critical that you execute this trade as quickly as possible when you hit your stop loss. So if you don't do it at the robot, can you do it at the broker? Yes, you can. And there's a lot of brokers that will hold that trade internally, and they're checking constantly with the CBOE to see what the market is. And if it violates your stop loss, then some brokers will immediately send it to the CBOE. Other brokers, like IBKR, will try and offset it against another one of their customers to avoid going through the exchange. And that takes time. And if they can't match it up, then they send it to the CBOE. And that causes what we call slippage, which we'll talk about in a second. The other way you can do it is you can tell your broker to, right when you put that trade on, to rest it with the CBOE. You want to rest it with the CBOE electronic book. Now that's a term of art that's very, very critical. The electronic book is what puts the trade in a particular order. As retail investors, we come before institutional investors. So that's an advantage. If you put it on, then they go by time. So when you put on your trade, if you're putting on that single trade, that short, and you put on a single trade stop loss order, that order will rest at the book. It was put on earlier in the day. You'll be early in line. The millisecond that stop loss is triggered, you'll be able to get out, which is really important, because if you've got a stop loss in there and you tell the market, well, I want to get out if I lose $100, then the second you're down $100, boom, it executes that trade. Well, that takes milliseconds to do. And then those milliseconds, that market might move to 105, 110, 120. Well, you can imagine if you have it at the robot, it takes a second. You have it at your broker, it takes a half a second. Now you're 1.5 seconds. That's over 15,000 milliseconds. And by the time that happens at the CBOE, you might be getting a fill at $140 or $150. That's called slippage. That's why I often tell people, when you're looking for a broker, remember, fees and commissions are pennies, slippage is dollars. Slippage is what's the most important thing. It makes a big, big, gigantic difference. Also, the CBOE only accepts single-legged orders. So when we put in the put credit spread separately and the call credit spread separately, but the stop loss, we put in just the short. So when you're buying it, you're doing it a spread and a spread. When you go to do the stop loss, you're just doing the short and just doing the other short, and those are separate. So remember, that's how you do it so that it rests at the CBOE. Be sure and verify with your broker that it's resting at the CBOE electronic book. Math, stop loss. 99% of all traders get this wrong. It is a challenge. Just look at this slide and walk through this with me. I'll try and make it so that you can always go back to this and figure out how to do it. When we put on the stop loss, remember, we're doing it on the short leg only, not on the put credit spread, not on the call credit spread, just on the short put and the short call. The formula, you take 95% times the premium that you received for the short leg only, and then you add in the premium that you received for the short leg only, and that's the amount of your stop loss. Let me give you an example. If the premium is $2, right? You're going to say, what's 95% of the premium received? Well, 95% of $2 is $1.90. Then you're going to add in 100% of the premium received, which is $2. So your total stop loss amount will be $3.90. Let's go to the next example. If the premium equals $3 and you have 150% stop loss, the stop loss is $4.50, which is 150% of $3 plus $3, the premium received. So the stop loss is $7.50. Let's do another example. If the premium is $1.50 and you have a 200% stop loss, we're going to get to a $4.50 stop loss. Let me show you how. 200% of the $1.50 that you received is $3, right? 2 times $1.50 is $3. Plus, you're going to add in the premium received, $1.50. So now that stop loss is $4.50. Now, one other little nuance. If you really want to maximize your rate of return, you want to sell that long the second your short gets triggered, your stop loss gets triggered. And you can either sell that long manually or you can use an OTO order, which is one triggers the other. So what we do in our funds, when we put in an order to buy a put credit spread, we put in an order, put in an order to sell a put credit spread, we put in an order to sell a call credit spread. Then we put a stop loss on the short legs only at the CBOE. Then we tell our broker we want an OTO order, one triggers the other. And we say when the CBOE sells either of our short legs, we want to sell the long leg at the market price. We want to get as much as we can for that long leg. A lot of people say, well, don't bother with the long legs. It's only a nickel or 10 cents. That's $5 or $10. But if you're doing hundreds of these a day, and say maybe you get an OT order on 50 of them at 10 bucks each, that's 500 bucks a day. There's 250 trading days in a year. That's a lot of money. Okay, that's a lot of money. So it is important to do an OT order if you can. Not all brokers will do OT orders. If they don't, just close them manually. But try and get as much money as you can for those longs as well. Now, I understand the math on this is complicated. You can rewind this video, go back, watch this part again. This is really important that you get this right. Next, we need to go over the EMA trade. It's the same as the MEC, except that we only enter either a put credit spread or a call credit spread. We let the robot decide which one to do. And what the robot does is it looks and compares the 40-minute exponential moving average to the 20-minute exponential moving average. And if the market, it gives more weight, the exponential moving average just gives more weight to the most recent times. And so what it does then, if it's going one direction, it puts on a put. If it goes the other direction, it puts on a call credit spread. You need to understand that with the EMA, we're not trying to predict the price. We're just trying to confirm the direction. We feel that, and the backtesting proves, that if the market is moving within those time periods in a certain direction, it tends to continue in that direction, or at least not to revert enough to trigger out your shorts. So that's why EMAs can be very, very profitable if they're executed properly. Very difficult to do manually. Probably need to do it with a robot, especially if you're doing any volume. The 100 or 150 wide part, just like on the MEX, the EMAs is the same thing. You're going to start going from your short when you look to buy the long, and you're going to start looking for the first one that's a nickel, and you're going to take that. If you get out to your maximum, say 100 wide, and it's still not a nickel, you're going to buy the long at that particular price. It's exactly the same as the MEC. All right, that's the end of part one. Now we're going to get into the meat of exactly how we do it and how you can do it as well. In parts 2, 3, and 4, we're going to talk about backtesting. We're going to talk about the EMA versus the MEC. We'll talk about entry time, premium points, and stop losses. Let's get ready to go to the next video. This is part 2 of our 30,000 DTE SPX trades a year series. This one is going to be on backtesting methodology. The scope of the backtesting methodology is really quite incredible. In SPX, 0 DTEs, there's 390 1-minute segments every single day. We're going to look at combinations of 2 strategies, so that's 780 trades a day. Then we're going to look at over 200 stop loss and premium combinations. And we won't look at all of them every week, but you'll see how very quickly we can get into 20 million backtests. For each combination of trades, we look at 6 months or 125 trading days. So 780 trades a day times 125 days equals 97,500 possible trades in 6 months for those 2 strategies. You can see here a picture of one of our backtests. It didn't do exactly every single trade of the day, and there were some holidays in there, so it only tested 94,000. But we're going to do this on all types of combinations. And we're going to repeat this strategy over and over and over again for every single combo of potential strategy, stop loss, premiums, etc. I'll show you in just a second. Here it is. You can see all the different back tests that we do, the type, strategy, time, premium, stop loss combination. We use Option Omega to do all of our back testing. There are other software out there. However, we like Options Omega. If you go to our web channel, our YouTube channel, you'll see a link in there, which if you use that link, you do get 50% off of Options Omega. They send me $15. I send that to the Humane Society to help the pets out there, the dogs and cats. So if you want to save dogs and cats, use my link to get 50% off Options Omega. That's the end of our ad. We often get asked, how is it possible to do 20 million back tests every single week? Let me tell you, it's nearly impossible. We couldn't do it without AI. But you start adding the numbers up and you see how very easy it is to get to 20 million. In fact, we have to work hard to keep it under 20 million. Because if you're talking about 392 strategies and you're talking about two trades, put credit spread and call credit spread for every single strategy, 390 entry points per day, 125 trading days in 6 months, because that's what we look back. Then you're looking at 10 premium targets, whether it's 50 cents, 75 cents, dollar, $1.25, $1.50, $1.75, $2, on up to say $4 or $5, then that's at least 10 premium points. Then you're talking about what are the stop losses, and those are okay too, but you have to say, well, what are these stop losses that you're looking at? Well, it might be 75%, 95%, 100%, 200%, 150%, 125, 250, 300, 400, 500. Again, it keeps going up and up and up and up and up. And you start doing the math at 2 times 2 times 390 times 125 times 10 times 10 is about 19.5 million back tests. Then you add in the opening range breakouts, the reverse iron condors, the double calendars, the wheel strategies, the naked puts, and all of a sudden you're very quickly over 20 million. And you could not do that without AI. We've spent about a year building AI to help work with our Options Omega to build out those particular back tests so that we can manage. It still takes multiple hours. We can barely get it done in one weekend, but that's how we do over 20 million back tests every single week. All right, now let's go on to part 3. We'll be talking about what we do with those back tests. Part 3, welcome to part 3 of our 5-part series about how we're going to put on 30,000 SPX 0 DTE trades a year. This one is called Structuring the Results. We're going to look at what we do with 20 million back tests every single week. As you might imagine, reviewing 20 million back tests every single week is extremely difficult. We have to use AI in order to do it. We can never do it, but it also requires some manual review. Then we use AI again. Then we do a final manual review. Let me show you how. The first thing we do is we take the trade logs from every single one of these back tests. So it shows every single trade, when it was put on, and whether it expired as a profit or whether it was stopped out. It does that 20 million times. We take all of those and we download those into AI. Then we've written scripts in AI. It took us over a year to build these out, and we continue to build them out. And we run it all through AI to analyze every single trade every single week. Once AI is done analyzing all these trades, it spits out a spreadsheet much like the one you're looking at here. So each strategy is going to return 6,600 trades. AI takes these trades, it builds a summary database, and then AI performs 22 different calculations for us for each 1-minute group. And actually that's up to about 25 calculations now because this continues to grow. It's an evolving process. For the purposes of this presentation, I only had to do every 7-minute trade logs to make it a little simpler for us. But you can see it shows you the AI calculates the entry time, the trading days, the P&L, the KGAR percent, the max drawdown, the MAR ratio, the Options Omega KGAR, the Options Omega MAR ratio, the margin required, the average premium, the capture rate, and the Sharpe ratio. These are all ratios that are pretty much publicly traded or public information. We also have about 10 proprietary analysis metrics that we use that I'm not displaying here. But to suffice it to say, the idea is that AI can take your data and can kick it out the way that you want to look at it so that you can start doing a detailed and deep dive analysis based on math. Remember, everything we do based on math, we bet with our heads, not with our hearts. Once we get all that data from AI, then we manually manipulate it somewhat and we work on trying to get it into a format that we like. And then we run it all through AI again. And again, this took about a year to figure out how to develop the AI methodology. One note of interest, we use the paid version of ChatGPT to do all of our analysis. And currently, we were using until 3 days ago Chat 4.0, even though Chat 5.1 was available. Chat 5.1 was not nearly as good when it came to analyzing this amount of data and doing it the way we wanted. 5.2 just came out a few days ago, and actually that is superior to 4.0. So we'll probably be migrating over to 5.2. At least we'll be testing it. But right now the testing is looking pretty good. So after we run it through AI a second time, it builds the summary sheet, just like the one here, although this one's just for every 7 minutes, which shows you each trading combo of trades, and we can compare it using different metrics. Now, that's the end of this part. The next part is my favorite part. It's called going to the ATM. It's not a money machine, although it is kind of a money machine, but it's the AI trading machine. This is something that we built, and this is going to show us exactly how to make the big money. Most important part's coming up. Welcome to my favorite part. This is how we use the ATM, or the AI trading machine. This is something that we built, we invented, and this helps us determine exactly what trades we're going to put on and when we're going to put them on and when we're going to take them off. This is where the rubber meets the road. This is where we make the money. This is the most important 5 minutes of this entire presentation. Drum roll, please. Here we go to the ATM, the AI trading machine. What is it? How does it work? As you might tell, I'm like a father. I'm very, very proud of the ATM, the AI trading machine. This decides exactly what we're going to trade, when we're going to trade it, and how we are going to trade it. It creates our master database. And by the way, what we're doing now is we're combining all of our weekly databases into one gigantic database so that we only have to add on an extra week each time to the end. It makes it a lot faster. But what the ATM does, it compares all the metrics, okay? It compares all the metrics, not just the car guard, not just the multiple max drawdown, not just the MAR, but all the ratios. It also does our proprietary metrics built by AI. And also, what it does is it looks at our trading patterns. We have some funds that are very, very aggressive. Well, they're going to be willing to accept a higher max drawdown in order to get a higher rate of return. What you will discover is the higher the max drawdown you're willing to live with, the higher your returns can be. However, we are human beings, and we know that some people, myself included, have a hard time getting a significant drawdown. Also, we have spouses, and we have children, and we have grandchildren, and we have friends and family, and they always want to know the same thing. How'd you do today? It's never important how you did today. When I was a professional gambler, I used to tell people it doesn't matter how I do today. What matters is how I do this year. If you're running a casino, they don't care about how one particular slot machine did or even how one day or one week went. They care about what were the returns for the year because they know that math makes money. Over time, we have a positive expected value. We have a mathematical edge, and we know we will make money over time. But as human beings, emotionally, what is the max drawdown we can take? And AI takes that into account. It learns the way you trade in each fund, and each of our funds is different, and it will tell you how to trade in each of those funds. And those are completely different trades based upon the way that you trade and the human side of what you're willing to accept. Risk versus reward, if you will. Now, we've just taken the ATM and we've gone to ATM 2.0. ATM 2.0 is where the AI magic really continues. We now have been comparing results over time. So let's say that, for example, last week or 6 weeks ago, the 1102 MEC was the #1 ranked trade. And now it's the 1206 EMA trade is the #1 trade. What we've started to do is started to track each of the millions of trades and determine which way is it trending. Is it trending up or is it trending down? Which ones are getting better? Which ones are getting worse? And by how much? What is the rate of improvement? What is the rate of decline? These things are important because we're trying to predict what the outcomes are going to be every single week. We also want to track sequential risk. Remember, there is a significant sequential risk. If you say, well, we only have 10 losers in 125 days on a particular trade, that's great. But are all 10 of those coming in a row? If so, you're going to have sequential risk. So we want to compare how those are looking relative to others as well. So we use pivot tables, we use sequential analysis, we use tracking, we do tracing, exponential moving average, if you will, of each particular trade. That's ATM 2.0. We love it. We've only been using it for a month, but it's really producing great results. The next step we call the ATM stoplight. And you notice I've got green, yellow, and red, and it shows you all the different times and strategies. Also, notice at the top, we've got two brown ones. Those are the super duper ones. But basically, the greens are better than the yellows are better than the pink. And so when we look at putting trades on, obviously we're not going to put all one lots. And so we're going to take multiples of the one lots. The pinks are the one lots, the yellows would be double that, the greens will be triple that, and the browns will be 4 times that. So if you're putting on 10 lots in a particular fund and you're doing a 10 lot for the pinks, then the yellows will be a 20 lot, the greens will be a 30 lot, and the browns will be a 40 lot. But the idea is we want to give greater value to the trades that we think are going to have a greater rate of return with a lower risk. So your risk versus reward, we want to put in those bigger lots on the trades that we think have a bigger mathematical advantage. You still want to spread your trades out over lots of different trades, lots of different times, lots of different strategies, because you don't want to have any concentration of risk. You want to be as uncorrelated as possible. But that's why we start with the stoplight analysis. Okay, Islands in the Sun is a great song, but we don't want that in our particular trading strategy. So we have our ATM is going to check for islands of time. You're going to find that there are islands of time. It's 1206, 1256, 1551. These are the current islands of time. And you don't want 20 trades going on at those particular times, even though those might be the best risk versus reward times and strategies. You just don't want to put all your eggs in one basket. You want diversification. So you have to look for islands of time and make sure that you don't overdo it on any particular island of time. It's still okay to go in a little bit strong on those islands, but you don't want to overdo it. Now, when the ATM is done with all that, it sets out exactly what our day is going to look like in a visual display. And here you can see on the far left-hand column, it just starts in the morning, and I've got this one set for every 7 minutes. But you can see when the trades are. You can see what the sizing is. You can see the islands of time that we're going to do. You can see the types of trades that we're going to do. All this built by the ATM. Sizing. Sizing can be a delicate matter in life, and just like it is within SPX trades. It's really important to watch your sizing. We have the ATM do a final run or another run looking at the sizing. We don't want to, even if you have only 2 trades being put on at one particular time, you wouldn't want them both to be 5-time multiples. Or if you have 3 trades, you wouldn't want 2 4s and a 5. That you want to be careful about the sizing on any particular time, any particular strategy. ATM looks for that, highlights issues, and then we manually change those. Resource allocation analysis. The next thing the ATM does, it looks at what are your resources available and how are you going to allocate them. I've given you a sample here of an account that's got $1 million in it, and we're going to take a look at how we're going to allocate that. All right, here's the fun slide. Most people like this slide. It's the last one in this part, and it talks about resource allocation, but most importantly, it talks about profit and loss. Everybody wants to talk about profit and loss. So let's take a look at, this is something the AI built for us. This starts off we started this account with $1 million on the start of the day. Now, I personally do an NQ strategy, a naked put strategy. I allocate 30% of my resources in most of our funds for this. Which means we're going to hold back $300,000 in buying power for that particular strategy. Then what we're going to do is we're going to hold back another 5% as a safety level, which is going to leave us $650,000 for SPX. So what's this over here? This is the stoplight that we used. You can see we're using, in this particular example, we're only using twosies and onesies, but that's the sizing that we're doing. We've also got a little double calendars in there, so you kind of disregard that. But this shows you the buying power, which is about $12,000 for each one of these trades. This shows you the total buying power for each one of these sets of tranches. This shows you the total premium that we're getting. This shows you the premium for the entire day is 24,400. That's what we would sell. We would expect a capture rate of about 13%. That's what we get pretty much traditionally. That's going to give you an average rate of return of about $3,172 per day. We're going to trade that 240 days out of the year. There's actually 250 trading days, but you got FMOC days, you got FMOC minutes, you got other days that you may not trade. You're on vacation, you're out having fun, you're on the beach, you don't get back in time, whatever. And so that's going to be about $761,000 that you're going to make on that $1 million before the NQs, which is about 76%. And this is what everybody wants to see. How much money will I make? This is not financial advice. Who knows? You could lose all your money. Don't do any of this just based on what we're showing you. Do your own research. But this is a pretty much typical what we expect to get in our funds. Normally, it's somewhere between 54 and 72%. This would be a little rich. And this doesn't include the NQs, but this is where we get to. All right, next, let's talk about robots. The next part, all about robots. Mr. Rebato, we are here to talk about robots, right? This is the fun part. We never trade with our fingers. We only use robots, which is okay. And so I'm going to show you exactly how we do the robots so that you can sleep in the morning. You don't have to worry about it. I put on over 125 trades a day in multiple funds, and I never do a thing. Maria just sees me laying out by the pool or going out surfing. It drives her crazy. But that's the beauty of trading with robots. All right, so up here you see a bunch of strategies that we put on, and this part is all about activating the robots and what's important, which is forward testing, which is what you do once you get results. Then you look back at your back tests and you say, did my back test accurately predict what actually happened? And if not, why not? Because you do want to make sure, it's the ultimate test to make sure that your back testing is accurate. We've got about a 99.2% forward testing accuracy. We love that. We think we're top of the field in this area. We're very proud of it. It takes a lot to get to that point. We used to be about 80%, but we are really proud of where we are in that forward testing mode. Options Omega is what we use for creating all of our robots. As I said earlier, we have a 50% coupon in our YouTube channel on every single video. You can get 50% on Options Omega. They send me a $15 stipend. I give that to the Humane Society so it can help with cats and dogs and all types of animals and pets. So if you want to save the pets, buy Options Omega with the 50% off coupon from Maria and Rob Trading, Rob and Maria Trading on YouTube. Okay. So here's a picture of Options Omega. You can see the little Options Omega thing over here. This is how you create the automatic strategy. Here's the string you get when you want to create the strategy. It's pretty straightforward. This is for a new strategy, and you just start off here. A lot of it will be filled in from your backtest. Once you get it filled in, then there's a whole bunch of choices you have to fill out. Thousands and thousands of combinations. You fill them out in your backtest so you can customize the backtest to do all the different types of stuff that we talked about and a great deal more. There's a lot to it, but Options Omega has all the details and all the training on how to do it. Once you start your setup, then you've got to do a setup for every leg. Remember, we're doing multiple legs, multiple entry condors. Put credit spread, call credit spread. You're putting them on separately as a spread, separately as a spread, and then you're closing them separately as a leg and separately as leg, separately as leg, separately as a leg. So Options Omega allows you to set up and customize all those details. Once you get all those customized, then you have to customize all your exit conditions. And you can see there's thousands of combinations here. You go over to Options Omega over here and you set that up. And again, you need to do this for every single trade. And each trade, if you're doing a MEC at 1206, don't forget that's a put credit spread and a call credit spread. So you've got to do it for both. You got to set up a separate trade for each one of them. There's a lot to it, a separate robot for each of them. Now here's the part nobody wants to talk about, the Punisher. The Punisher is all the bad things, the fees, the commissions, the slippage, how you're going to, do you want 2 consecutive hits at stop loss, all the different variables you have for closing down and accounting for your trade, all that in Options Omega. It's a lot of work to set this up and you have to do it for every single trade. Once you get all that set up, the fun part is you just hit automate. And what do you know? Your robot is born. It's not trading yet, but your robot is now born. Active. That's what you want to do. You want to make your robot active. And once you make it active, then it actually is trading. Here's the active button. And what we do every single week is we get all these trades active so they start trading for us. So we figured out the strategies. We've done 20 million back tests. We created all the strategies, the robots. We then, what do we do mechanically? Every Sunday night, we're going to take off 25 trades, 125 trades from the week before. We're going to close all those down, and we're going to turn on the 125 trades for this week. It takes about a minute per trade, so that takes about 250 minutes. You do the math. I think that's somewhere around 6 hours to set up these trades every single Sunday night. Once you do that, you need to click live to make sure that your trades run in real time. If you forget to click live, Option Omega won't trade any of them. You need to make sure that it's live. And what do you know? All 125 trades start going on automatically until you tell them to stop. All right, here's the fun part, the results. We use the results to forward test. So you can, Option Omega has great reporting features. We absolutely love the reporting features, better than any brokerage we've ever used. Here's a typical 90-day pattern. I think we talked about one the other at the beginning that had 218,000. Here's one with a little bit different days. And you see in 90 days, we made 7,700 trades and collected $1.8 million in premium, captured about 10%. Our average winner, average loser, our profits, and we made 18.87% in 90 days. So you can get a pretty good, take 4 times that, you're going to figure out where you're going to be somewhere between that 50 to 72, 56 to 72 range, somewhere in there, 52 to 74, whatever it is. All right, we're coming to the end. What you've learned today, you learned how to pick the trades. You learned how to execute the trades. You learned how to talk the SPX lingo. Now you can tell your friends and neighbors, I know how to do a 1002, $2 MAC, 150 wide, 95% stop loss, and they'll look at you like you're talking Chinese. That's great because now you're really a professional trader. I hope you've also learned today that math makes money. We trade with our heads, not with our hearts. You have to do lots and lots and lots of little trades because you want to hit that bell curve. Remember, if you do 100 trades, you're going to have about a 98% chance of hitting the bell curve, the predicted back test. If you do 400 trades, it's going to be about 99.99. If you do 30,000, it's going to be 9.999999999, whatever. If you've learned anything of value today, I would really appreciate it if you went to our YouTube channel, Rob and Maria Trading. If you would just subscribe, watch a video or two, and hit like, it would be great. If you're watching this on YouTube or any of the parts, if you would just hit like and subscribe, we'd really appreciate it. It really helps the channel, and it helps us bring our experiences to lots of other traders. I hope you have a great trading day. Put anything you want in the comments, any questions you have. We do try and read and respond to every single comment if we can. Thanks a lot and have a great day.